Hello everyone, it's Aprilia and welcome back to my channel. So today I'm going to tell you about the insurance regulatory trends in South Africa. If you want to know what is trending at the moment in the non-life insurance regulatory space, it is broker fees. Non-life insurers have been asked to justify their facilitation of broker fees under Policyholder Protection Rule 12.4. The Insurance Act 1943 didn't mention broker fees, which were a matter between the broker and their client. Under the Short-Term Insurance Act 1998, Section 8 permitted independent intermediaries to charge their client a fee, commonly 10 until 15%, as long as it was disclosed expressly and separately to the policyholder for those extra services that broker provided to their client, which were not intermediary services as defined. The FAIS General Code introduced Section 3A in 2010, which entitles the independent intermediary to charge the accrued fees for additional services, which the client can stop it in their discretion. The policyholder protection rules applicable to natural persons and small businesses eventually introduced Rule 12.4 to provide that the insurer may not facilitate the charging of a broker fee except under certain circumstances. Facilitate in this context means adding the fee below the bottom line of the schedule and collecting it on behalf of the broker. The insurer has to satisfy itself that the client has agreed to the fee in writing, that the fee related to an actual service provided to the client, and doesn't remunerate the broker twice for the same service. Non-life insurers have been asked to provide information to the FSCA regarding the facilitation broker fees, instead of the FSCA checking on the brokers themselves under the FAIS Act, where Rule 12.4 requires an actual service to be provided to the client. This means that the service is available but not necessarily performed during a particular period of insurance for a particular client. The fact that the broker has in place the skills and infrastructure, for instance, to give risk management advice, to do risk surveys, to do all the extra things that surround a claim for replacement and repair of damaged goods, and to perform other helpful services is sufficient as long as the services are available when the client needs them. The fine line between outsourced or intermediary services and services for which the broker fee is paid is not easy to draw and is never a straight line. When does advice given by broker to the client as to what to insure, what to self-insure, and what to ignore when taking out a policy eventually shift into performing an act as a result of which someone enters into a policy? There are many similar examples. The phrase the insurer has to satisfy itself as to the charge is important. Reasonable steps have to be taken. Brokers have to produce and insurers have to consider the list of the services for which the broker fees is paid to see that there is no duplication. The South African market is a highly intermediated market that the fairness to policyholders relies extensively on the role of brokers in the market. Many clients are prepared to pay a broker fee for the personal and additional services they get from their favorite broker. If the insurer is facilitating the collection of fees which are described in the written agreement between broker and client as something in addition to what the insurer pays for, there is not much more than an insurer can do. The wording of Policyholder Protection Rule 12.4 clearly understands the situation. Okay, thanks for watching. Don't forget to like, comment, and subscribe this channel. See you to the next video and bye bye. welcome to my channel. Don't forget to like, comment, and subscribe. Compare term insurance. Term insurance is the most affordable type of life insurance product that provides financial security to your loved ones for unforeseen events in your life. They provide high-level life coverage at low premium rates with comprehensive add-ons based on your lifestyle. In order to choose the best term insurance plan for yourself and your family members, it is important to do a term insurance comparison. Thus, it is always important to buy the right term insurance plan to avoid any financial problems for your dependents. What factors to consider while comparing term insurance? There are few certain factors to keep in mind when planning to compare term insurance online. Some of them are: the first is premium payment option. Term insurance plans, along with low premium rates, also offer premium payment flexibility through different options. You can select from 3 available premium payment options, which are limit pay, single pay, and regular pay. And then number 2 is sum assured. It is vital to ensure that the sum assured is enough to cover your beneficiary expenses. As the whole point of the term insurance is to make sure your loved one can lead a better life, it becomes important to choose the insurance coverage that will be sufficient for them. Before deciding on a sum assured amount, it is crucial to assess the current financial liabilities, assets, and dependents. As per financial expert, a life cover at least 10 to 20 times your annual income is recommended. And number 3 is premium amount. It is important to assess your family requirements and financial condition while comparing term plans. The premium amount payable under a term plan varies on the basis of the coverage amount selected. Simply put, the more the chosen coverage, the more will be the premium amount payable. It is also advisable to use a term insurance premium calculator for an easy calculation of the premium amount required to pay for the right coverage. It can help you make an informed decision as to which plan you want to opt for. And then number 4, riders for a comprehensive coverage. When buying a term plan, you can increase your coverage by adding add-ons or riders to your best term life insurance plan. They are available at additional prices. When comparing term insurance plans, you should consider different types of rider benefits like premium waiver and accidental disability or death. It is suggested to first assess your needs and then buy a term plan that involves the add-ons you want to add to create a financial protection net for your family. And then number 5 is duration of policy coverage. Today, you might be in a good health or in a financial stable condition, but you cannot predict the future. Term insurance plans help you choose the right term plan for your family members. And when comparing plan benefits, you can select a policy term that involves both your working years and after retirement years, thus enabling you to have long tenure financial security even if you don't have any regular income source after retirement. And the number 6 is GSR or claim settlement ratio. With a number of life insurance companies offering term insurance plans, it is important that you thoroughly compare term insurance plans and consider the company's claim settlement ratio or CSR tells the past record and trustworthiness of the company related to term insurance claims. The more GSR, the more reliable the insurance company is. And then number 7 is free look period. Free look period is the amount of time provided to a policyholder to review and assess the term and condition of the policy documents. You have the option to terminate the plan during the free look time if you are not satisfied with the exclusions and inclusions which were informed at the time of buying. The free look period changes with the mode of insurance purchase. For insurance plans bought offline, the free look period is usually 15 days, whereas for online purchase it is 30 days. It can change depending on the insurance offering the plan. Okay, that's for today. Thanks for watching. See you in the next video and bye bye.